Hey everyone, welcome back to Canada Accounting Insights. Today we're going to break down a topic that shows up everywhere in exams, in financial reporting, and in the real business world, investments. By the end of this video, you'll understand the main types of investments, debt and equity, the difference between strategic and non strategic investing, how these investments are accounted for under IFRS, and the key differences under ASPE. Before we dive in, hit the like button and subscribe. So let's get started. What are investments? At its core, an investment is when an entity puts money into financial instruments with the expectation of earning a return. These returns can come in different ways: interest from debt instruments, dividends from equity instruments, or selling the investment at a higher price than you paid. From an accounting perspective, we group investments into two big buckets: debt instruments, things like bonds, debentures, treasury bills, or money market funds. Equity instruments, shares of another company, either common or preferred. Now that we've set the stage, let's dig deeper into the first category: debt instruments. Debt instruments are considered non-strategic investments. Why? Because owning someone's debt doesn't give you influence over their operations. It just earns you a return. Let's break them down. Money market instruments, short-term, highly liquid, and low risk. Examples of money market are treasury bills, term deposits, bankers' acceptances. Their value doesn't really fluctuate. You just earn interest. Perfect for parking excess cash temporarily. Bonds and debentures. Bonds are a promise to pay back principal plus interest. Can be secured with collateral or unsecured debentures. They may include features like callable bonds, when issuer can redeem early; retractable bonds, when investor can force redemption early; convertible bonds, this can be swapped for shares. There are some key bond terms that is important you know, like face value or par value. It's the amount paid back at maturity. Coupon rate, it's the stated interest rate. Effective interest rate, it's the actual yield considering compounding. Discounts and premiums, it's when bonds are issued at prices below or above the par value. That covers debt instruments, which are all about income and security. But what happens when investors want ownership and growth potential instead? That's where equity instruments come in. Unlike debt, equity gives you ownership, common shares, voting rights. Participate in company growth. Public shares are liquid and transparent. Private shares are harder to value. Preferred shares, priority over common for dividends and liquidation. Usually no voting rights. So equity investments can be either non-strategic, small holdings, no real influence, or strategic, significant ownership, potential to influence or control. And that leads us to an important question. What exactly makes an investor strategic or non-strategic? Let's break it down. Not all investors are the same. Let's separate them into non-strategic and strategic. Non-strategic, passive investors. Their main goal is earn income, interest, dividends, trading gains. No influence on the investee. For example, a company buys 0.5% of another firm's shares. Clearly passive. On the other hand, strategic investors invest for business reasons like securing supply, gaining distribution networks, diversification, limiting competition, accessing technology, achieved through common shares with voting power. Like, for example, buying 35% of another company, significant influence, or owning over 50%, control, usually leading to consolidation. Now that we know the difference between passive and strategic investors, the next big question is, how do we actually account for these investments under IFRS? Here's where exam questions love to test you. How do we account for these investments? Non-strategic investments under IFRS are short-term debt, like T-bills. They are measured at amortized cost if held to maturity. Long-term debt, like bonds. They are measured at amortized cost if held to maturity. Trading debt instruments, they are measured at fair value. Equity instruments, also measured at fair value. Strategic investments under IFRS are associate, 20 to 50% ownership. Equity method, joint venture or joint operation. Equity method or proportionate consolidation. Subsidiary greater than 50% control, consolidation. So under IFRS, the method depends on ownership percent and level of influence. But here's where things get interesting. Canadian private companies using ASPE don't have to follow the same strict rules. Let's compare. Now let's look at where ASPE gives more flexibility. Equity investments, non-strategic. See the left side, IFRS, measured at fair value. ASPE, cost method allowed if not traded in an active market. Associates, 20 to 50% ownership. IFRS, equity method is required. ASPE, can use equity method or cost method, unless shares are actively traded. Subsidiaries greater than 50% control, IFRS, consolidation is required. ASPE allows equity method, cost method, or consolidation. Debt instruments, IFRS, measured at amortized cost or fair value depending on intent. ASPE amortized cost, but can elect fair value at initial recognition if reliable. So the big difference, ASPE provides options. IFRS is more prescriptive. That flexibility under ASPE can significantly impact financial statements. All right, and this is the end. Let's do a quick recap. Investments fall into debt or equity. Investors can be non-strategic, passive, or strategic, significant influence or control. Under IFRS, treatment depends on ownership percent and purpose. Under ASPE, you often have more choice: cost, fair value, or equity method. Understanding these differences is not just exam critical, it's essential for preparing financial statements in the real world. So if you're studying for the CPA exams or just building your practical knowledge, this is one of those foundational topics you need to have locked in. Thanks for watching today's lesson on Investments Overview. If you found this breakdown helpful, don't forget to hit like and subscribe to Canada Accounting Insights. Comment below if you'd like me to cover associates, joint ventures, and subsidiaries in more detail. I'll be happy to build a video around that. See you in the next lesson!